Now, let's try to see the quick ratio. What does that mean? So basically, quick ratio is simply trying to tell you that how much quick assets you are having in your business. When I say quick assets, it simply means the assets or the current assets, I would say, which can be quickly converted to cash. So if we see the cash or cash equivalents, definitely cash is quickly converted into cash because that is itself the cash. But cash equivalents, just like short term investments or just like equivalent to money, they can also be converted to cash very quickly. Short term marketable securities is like you have invested in certain mutual funds or shares, so these can be sold and money can be got within 1 to 2 days or 5 days or 7 days. And finally, net receivables, you get the money from your debtors quickly as well. Definitely, these three elements consist of within the quick assets or quick ratio on the top. Basically, what are not included here? So you can say two types of main items are not included. One is your inventory. Why inventory is not included? Because when you sell the inventory, before selling, you have the inventory for a longer period of time, so that blocks the money. After selling it, it will create the debtors and finally you will get the cash. So it's a long process to generate cash from inventory, so that is not the part of the company's quick ratio. So along with the inventory, there is a situation of prepaid expenses as well. For example, you have given advance rent to someone else. So now that advance rent is there, but you cannot use that at the moment, because when the time will come, you will be getting that money back. So that is a different thing and different phenomena. But yeah, quick ratio does not include inventory and prepaid items, I can say. Now in the numerator was this thing, now in the denominator current liabilities will be there. So effectively, if we go to our example again, the balance sheet. So for our balance sheet, on the current asset side, 50 will be part of our quick assets. Current accounts receivable will be part of our quick assets, but this 80 won't be part of our quick assets. So effectively, our quick assets will become 170 here, and our current liability will remain 100 here, which includes the accounts payable and short-term debts. So if we go to our this quick ratio here, so we will say 170 is our quick assets and 100 is our current liabilities, making it 1.7. So quick ratio is 1.7 for the company. So this is also good because this is the most efficient way the company is having the cash within their business. Now let's try to understand how and why this quick ratio is used. So this is the true liquidity test, because this is the highest amount of cash which can immediately be converted into cash through different means, whether it's short-term investments, cash or cash equivalents, or your accounts receivable. Now it measures the company can meet its short-term obligation without selling inventory. So inventory takes a lot of time, but this does not take the inventory into their account. Similarly, this is more conservative than current ratio. If someone is more riskier, then they will see, okay, what is my liquidity ratio, or not liquidity ratio, quick ratio. Now this is also used for stress test or cash crunch. So if the sales suddenly drop or inventory become unsellable, quick ratio shows the company can still survive, because the company may have a very good current ratio, but if there is a very high level of inventory within the company which cannot be used, then current ratio won't help. So excluding inventory, this ratio is calculated. Similarly, creditors and lenders choose this ratio, and you can use it for industry benchmarking to compare other industries as well. Now let's take some real world example. In the case of Amazon, current ratio is like 1.1 and quick ratio will be slightly lower, but still the company have slightly lower quick ratio, but it will be healthy because it has a very high cash collection frequency. When you order from Amazon get the cash immediately. So they, or even if they are having certain partners where the receivables are there, but they are having very less receivables as well, so the quick ratio will be slightly lower compared to current ratio, but still they are very good. If we go to Walmart case, current ratio is less than 1, quick ratio will be even lower for the Walmart. Why? Because this looks weak, but Walmart has a daily cash inflow. So if they are having daily cash inflow, they are not having any accounts receivable, they are having inventory, but inventory comes and it immediately goes, so there is no holding of very much inventory as well, so there is a quick flow for them as well. If we see the Tesla automobiles, so inventory is huge for them, cars in production or they are waiting to sell, so quick ratio is much lower than the current ratio here as well. Why? Because in the quick ratio, if some inventories are sitting within the company's I can say current ratio, current assets, they won't be counted. So this simply depends, if they will be able to sell more inventory quickly, then they will be able to get more cash for their business. And Apple generally maintains a quick ratio of 1, which is slightly good. So overall, the quick ratio simply says that what is your stress test and how quickly you can generate the cash from the business, and if you have generated that, how quickly you can pay off your liabilities.